Because of the kind of work we do and the sheer volume of it, we see a lot of investment statements from people all across Canada. We have literally seen it all. And we know what works and we know what does not work. We know the difference between being positioned a few degrees this way versus being positioned a few degrees this way. And the difference is hardcore. Let me show you. My name is Reese. I'm a chartered investment manager, a fellow of the Canadian Securities Institute, and a financial planner. And today, I want to show you some things that are very easy to grasp, but yet can make a massive difference in your life. And depending on how old you are, it could really help you shortcut the whole retirement thing by years. But even if you're already retired, it could add years of extra income, or at least add to the amount that you could spend each year. Anywho, here's what we're going to do today. First, I'm going to very clearly, quickly, and simply explain the basics of how almost all investment portfolios are built and how the type you choose matters so much it's ridiculous. I will use zero jargon. This will make total sense to you, even if you currently know nothing about any of this, and it could very easily lead to you having way more resources for the rest of your life. Next, I'm going to run through some common objections to pretty much everything I'm saying here today. And finally, I'm going to bring it home with a little story that's made at least one couple quite well off. Let's do it. Portfolio basics and the ridiculously hardcore impact of your choices. Okay, now there's really only two things you can do with your money if you want it to grow. You can be an owner or you can be a loaner. Now, obviously, we're talking about investment portfolios here. And so when I'm referring to owning and loaning, I'm not referring to owning a trampoline or lending money to your kids. We're talking about financial assets, things we expect to make a return for us. So on the owning side, we're talking about things like businesses. You can own pieces of businesses. And in fact, that's exactly what stocks are. When you buy a share or a stock in a business, you're just buying a piece of it so that you can own a piece of the profits. Simple. And by extension, a stock market is just simply a place where you can buy or sell these pieces of businesses. There is nothing magical or scary about any of that. Now, on the loaning side, we're talking about things like bonds or even savings accounts or GICs. See, when you put your money in a savings account or a GIC, the bank doesn't just take your money into the back room and put it in a pretty little box with your name on it and then just come back in there from time to time and sprinkle a little interest in there. What's actually happening is that you are lending them that money, usually at a very pathetic rate. And then they turn around and lend it right back out, maybe even to you for your mortgage or whatever, but at a much higher interest rate. And then they keep the spread. It's a good gig for them. Kind of makes you want to be an owner of them and not a loaner to them, doesn't it? Anyway, a bond isn't much different. It's just a fancy way to lend money to a government or a business. So there you have it, owning and loaning. And for the most part, that's what investment portfolios are made up of, stocks and bonds, owning and loaning. And most modern portfolios are quite diversified. Lots of different stocks and bonds, lots of owning, lots of loaning to make sure that you are very well spread out. Yes, obviously, it gets more sophisticated than that, but at its base level, this is all a portfolio is, owning and loaning. But, and it's a big but, how much of your portfolio is dedicated to owning and how much of your portfolio is dedicated to loaning is the part that has the ridiculously hardcore impact on the rest of your life. So let's break this down using this really clear and easy to understand chart put out by Vanguard, which I will link in the description below if you want to look deeper. But before we get into it, I just want to say that this chart is using data from the United States, and the numbers haven't been quite as good in Canada. But in pretty much any diversified portfolio you have in Canada, you're still going to have a large chunk of the portfolio invested in US assets anyway. But the point isn't the exact numbers. The point is the long-term effects of owning versus loaning. And this chart shows that beautifully. And it shows us numbers that go back to 1926, before the Great Depression. So you can see that it's not just cherry picking nice years. It's showing us the good, the bad, and the ugly. So let's look at this first column. You can see down here that this column is showing us the best, worst, and average long-term rate of return for a portfolio that was 100% bonds, or in plain English, like we've been speaking in, 100% loaning. A person who had their money invested in this portfolio owned zero stocks. They were loaners with their money and not owners with their money. Anyway, you can see that over this nearly 100-year period, the worst year they ever had was minus 13.1%. The best year they ever had was 32.6%. But the number that really matters is the one above the little white dot. This is the average annual return for the whole period, 5.1%. So, after a century of rising and falling interest rates and all sorts of other drama, they made an average of 5.1% before fees. Now, let's keep things moving and jump to the other side of the chart. In this column, we can see the best, worst, and average long-term rate of return for a portfolio that was 100% stocks, or in plain English, 100% owning. As you can see, this is a much taller column, and that's because the one-year swings are much more volatile. Now, I've already done a video, which pairs beautifully with this one, on how and why owning is more volatile than loaning, and also why, over the long run, volatility always passes, no matter how hardcore the storm. And this is clearly observable simply by looking at history. The Great Depression, World War II, 9/11, the financial crisis of 08-09, etc., etc. Over the last 100 years, we have been through some crazy things, and the stock markets did not like it. They threw a fit every time. But each and every time, they not only recovered, but moved on to brand new heights. Not some of the times, all of the times. Now, I'm not here to convince you of this. I simply want you to see it so that you know. Now, back to the owning column. Best year ever? 54.2%. Mother of pearl. Worst year ever? Minus 43.1%. Brutal. No matter how tough you are, that is a rough year. But the number that really matters is the one above the little white dot. The average annual return for that whole century, 10.2%. Delicious. Literally double the rate of return earned by the loaner. Was it a smooth ride? No, it was bananas. Can everybody handle bananas? No, which is why there are all sorts of different portfolio options available to you. You don't have to be 100% loaner or 100% owner. You can be a blend. And in fact, that's what most people choose. And actually, in financial speak, that's what makes somebody more conservative or more aggressive, when you change the weighting of how much you own and how much you loan. The more loaning you do, the more conservative your portfolio is thought to be. The more owning you do, the more aggressive your portfolio is said to be. And whatever direction you lean in will affect the long-term rate of return that you will experience. If you want to be half owner and half loaner, go ahead, fill your boots. But you probably shouldn't expect anything more than the long-term average of 8.1%, and probably quite a bit less if you're in a high-fee environment, which most Canadians are. And actually, this half and half split is often referred to as a balanced portfolio because you're balanced between how much owning and how much loaning you're doing. Now, technically speaking, most balanced portfolios are actually a 60-40 split. So 60% owning and 40% loaning. They like to slide in a little extra owning just to beef up their returns a little bit without increasing the volatility too much. So next time, if you're looking at your investment statements and you see the word balanced in there, now you know why. Now, if you want to be a bit more aggressive than that, but not go full tilt, then maybe you end up in something like an 80% owning and 20% loaning mix, which is often referred to as a growth portfolio. And according to history, this would lead to better long-term returns than a half and half or a 60-40 mix. A more volatile ride for sure, but you're doing it for a reason. more growth. Now, obviously, there's more things that we could say about all this. We could definitely get more complicated. But for 95% of the population, this is the main thing that you need to know. In sum, how much you own in your portfolio and how much you loan in your portfolio dramatically impacts what your long-term rate of return will be. And your long-term rate of return dramatically impacts how much your portfolio grows. And the size of your portfolio dramatically impacts when you can retire and how much money you can spend while you are retired. This is not a little deal. It's massive. And I'm going to prove that with this really cool calculator that not only shows what a portfolio can grow to based on whatever percentage you type in, but it also shows you what it looks like if it makes a certain percentage more and a certain percentage less, so you can compare. And again, I'll link the calculator below. Now let's assume you put in 100 grand and you don't add anything more than that, but simply leave it for 20 years. And let's give you a long-term rate of return of 7%. Now here, where it's asking for the variance, we'll type in 1 so that we can see what it looks like if we make an extra 1% on top of the 7%. So 8% over 20 years. And we can see what it looks like if we make 1% less than 7%. So 6% over 20 years. And then hit calculate. And there we have it. At 7% a year, over 20 years, our 100 grand turned into 387 grand. If we made an extra 1%, so 8% a year for those 20 years, we would have 466 grand, way more. That is a $79,000 difference. Now, depending on how much money you want to spend each year in retirement, that could lead to at least an extra 1, 2, 3 years of retirement income, especially when you factor in that not all of your retirement income is coming just from your investment portfolios. You're probably going to at least have some CPP and some OAS. So that $79,000 of extra growth could add tons to your retirement. Now, on the flip side, if you were to only make 6% instead of 7 or 8%, you can see the big impact there as well. You're down to 321 grand. Bit of a bummer. It's one thing if you compare that number to the 387 grand you would have if you made 7%, but it's downright depressing if you compare it to the 466 grand you would have had with 8%. That is a $145,000 gap. Years of retirement income. Now, what if we change the original investment to 200 grand and add in a monthly savings of $300 a month? And let's just leave everything else as is. Well, look at that. Everything just amplified big time. The differences just got more hardcore. And therefore, the implications for the retirement income did too. And we haven't even touched on how inflation impacts everything. But I'll give you a hint on that one. If the cost of everything is going up by about 3% a year, and you're only making about 3% a year, then that is a straight up wash. You won't grow at all in terms of your purchasing power, which in real life is all that actually matters. Now, in a sec, I'm going to go through a bunch of objections to pretty much everything that I've been saying here. But before we do that, I want to hit this from just one more angle to make sure it's all really sinking in. This chart is a beauty. There's a number of things going on here, but what we care about are these horizontal blue bars. You'll notice all these percentages over here on the left running all the way down. This chart is simply showing us how many years it takes for your money to double at each percentage of return. So at a 2% rate of return, we can see that it takes 35 years for your money to double. At a 3% rate of return, you can shave off 11 and a half years. Crazy. That 1% difference is a total life-altering game changer. Now let's speed things up and drop down a few bars. At 7%, it now only takes 10.2 years to double. At 10%, it only takes 7.3 years to double, and so on. So to put some skin on this, if you had 100 grand and were averaging 10% a year returns because you decided that you wanted to be a full tilt owner, after 7.3 years, you would have 200 grand. After 14.6 years, you would have 400 grand. After 21.9 years, you would have 800 grand. After 29.2 years, you would have 1.6 million. And that's without adding any additional money along the way. So yes, your rate of return really, really matters. Now, what about the classic objections to all of this, to this whole line of thinking? Well, the first and maybe the biggest is that regardless of what we've seen in the past, you cannot guarantee that having an owning portfolio is actually going to get you an average of 10% a year in the future. And that's true. All sorts of things can happen, especially in the short term. But you can bet your sweet bippy that if you do not have that kind of portfolio, then you will not see those kinds of results. Another classic objection is that if you get more aggressive with your portfolio than you can actually emotionally handle, then the next time there's a big market crash, you could very well panic, abort the whole mission while your portfolio is in the toilet, sell, and therefore lose a ton of money. Yes, 100%. Totally agree. So, as with everything else in life, do not bite off more than you can chew. Only do what you can handle. Of course, this video is not meant to talk you into swan diving into the deep end of the pool. It's meant to help you understand the basics of portfolio construction, market history, and compound growth. Because the fact is, the more clarity that you have on any specific thing, the less that thing feels like voodoo. You start to engage it from a position of knowledge as opposed to a position of fear. So you just start to make better, more informed decisions. The last objection I hear fairly frequently is that you need to get more conservative the older you get, especially once you're retired. But why? Does your need or desire for growth just disappear because you turn 60 or 65 or whatever? Don't you still have another 2 or 3 decades ahead of you? Now, I get it. The perceived logic here is that since you now rely on your investment portfolio for income, you are less suited to handle a large market downturn. And that's fair. But all you need to do is be smart about it. You see, the fact is most market downturns don't last that long and they generally don't go down that deep. And so you're usually fine to just ride right through them. But if they do last that long, or if they do go down that deep, then you can simply mitigate all of that by having a war chest, a chunk of money that you maintain on the side in a high interest savings account or something like that. This way, you don't have to sell from your investment portfolio while it's down in the toilet. You can simply pull from your war chest instead. And then once the markets bounce back up, like they always do, you can resume pulling from your investment portfolio and even top your war chest back up. If you haven't seen my war chest video, you should. It answers this whole thing very clearly and in depth. It's bedrock. Now, to put the final nail in this, I want to leave you with a quick, awesome story. A couple of months ago, we were bringing on some new clients from Fort McMurray. Straight up, awesome human beings, and actually had a fairly large portfolio as well. And we were talking about how markets work and how volatility while you're in the wealth building phase can actually be really great for you. And with a big grin on his face, he said, "Yeah, you just buy more tuna." And by the look on my face, he could tell I had no idea what he was talking about, and so he told me the story. Way back when he was a young worker bee at a mine, the company that he worked for brought in a financial advisor to talk to the whole crew about retirement planning. And after talking to them about risk and return and volatility and all that kind of stuff, he asked them how many people in the room eat tuna. And apparently almost everybody rose their hands. And then he asked them, well, what do you do when tuna goes on sale? And pretty much everyone said, you buy more, obviously. And that's when it clicked for him. If it's that obvious with tuna, then why don't we do that with our investment portfolios, which own some of the best, most profitable businesses in the world? When they go on sale, why don't we just buy more? It was a tiny, uncomplicated analogy about tuna that turned my client into an entirely unsophisticated, yet wildly successful long-term investor who, rather than running in fear whenever markets dropped in value, stuck to his tuna guns and simply bought more whenever they went on sale. So do what you will with all of the things that I've shown you here today. But as for me, I'm going to buy more tuna.